Deep Dive with David Stendhal, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey, it's David Stendhal with tonight's Deep Dive. I'm going to do something a little bit different this evening. I just want to show something that's on our website so you get a feel for how to use some of this information. So what I'm going to talk about tonight is kind of a target for the different markets. And so what we have here is a support and resistance level, and you can see that the trade date is for today. We'll produce this in the evening time, and then it'll be used the following day, meaning today. And so what it'll do is it's going to show what the close was yesterday, and then we're going to have two upside targets, a little triangle and this little square. You'll see the exact number as to what those targets are to the upside, and then we'll have targets to the downside should the market fall. We'll again have a triangle and we'll have a square. The triangles that are obviously closer to the previous day's close, they're the targets that we think that the market could legitimately get to. The upper end here, the squares at the very top and the very bottom, they represent what we'll term as an extreme move for the day. So what I want you to do is when you take a look at these charts, always focus on the diamonds and get a feel for how much risk is out there and what the target is on the market. So there's two things that are really here for us. One is, could the market rise? And if so, what's a logical spot for it to rise to as a minimum? And what you'd be looking at is most likely you're going to see that the price action is going to rise to the diamond and below that of the square. And if the market should fall, it would be somewhere between the diamond and this particular square here. Now what I want you to see is you can see that the numbers as far as the range between the upper diamond here and the lower diamond relative to the circle, you can see that it's skewed a little bit. That's because what we do is we look at and evaluate a market based on its historic preference, and then based on that condition we're able to calculate a logical reference where the market should likely head to. So with today's action, we were up around 2844, I believe, if we pull things up here. So here's 2844. So the market was actually above that particular threshold, but at least it'll give you an idea as to where the market theoretically could rise to if it's going to be bullish. Now, this will give you dollar amounts, or excuse me, price levels for the market. The other thing that we can do is we can come up with dollar risk. So it's using the same information. So if you come down to performance, you come down to dollar risk. We break this down in two different ways. One, we do an evaluation for the next day, meaning today. We'll do this evening for tomorrow. And what it'll do is it'll look at a conservative and an aggressive. If I click on the aggressive, you'll see that the numbers change here. And what we're looking at is those diamonds that we were referring to, they represent the conservative point where the market theoretically could go and how much risk is involved if you're on the wrong side of that. So in this particular case, here's the S&P 500. You can see long risk and you can see short risk. Now it's not necessarily the easiest thing, but if you pull up on your screens, it'll become a little more clear. So the lighter one represents the long risk. So if you're long the market, your risk is the market falling, and if you're short the market, then your risk is to the upside. So just understand what we're looking at here, and what we're attempting to do here is how much risk would we have if the market were to go to those diamonds. Now, I showed you those squares on the previous chart. Well, that's where the aggressive levels are going to come from. You can see that they're much larger. Now look at the S&P relative to, say, corn on the aggressive. You can see that it's much more aggressive, and we would trade obviously more corn contracts to equate to that of the S&P 500. But for our purposes right now, we're just trying to get a feel for where could the market head to, and if you're new to a market, how much risk are you actually taking from the long side or the short side. So therefore, we would use this type of a screen just to do a comparison against all the other markets. Now, the other thing is that sometimes these numbers are hard to see and know exactly what the risk levels are. So we also break it down. If we come down to dollar risk, you come over to dollar risk by market. Then what we'll do is we'll present a list of the different markets that are out there. Click on the S&P 500 here. And what it's going to do is it's going to give us the exact numbers that we're going to be looking at. So again, long dollar risk. If you're long the market, you think that it's headed higher, your risk, if it should go the opposite direction, is to the downside. So you can see that the numbers on the downside, the risk associated with being long, are larger than what they are for the short dollar risk, because in this particular condition, there's more risk to the downside than there is to the upside. So simply look at this as obviously risk per contract. You can also flip this around and you can look at the dollar risk and say, what is my opportunity? And the opportunity is for the market theoretically to be up $937 up to $250 or $2,511, somewhere in between that. So I don't want to confuse the scenario, but I want you to understand that we have targets that you could use for the market and get a feel for where the market likely could go if it picks up any type of momentum. And if it has a lot of momentum, it's going to rise to even higher levels. Then the other thing that I would have you do is you can look at this type of a chart, get a feel for how much risk a particular market has at the present time in comparison to the other markets. And if you're going to actually trade a market, and some people obviously are trading the S&P 500, but you may not be trading other markets like lean hogs or corn or platinum, whatever the market may be. It's a good thing to sort of assess the market and get a feel for, could I handle dollar-wise the risk of the market rising or falling based upon the opposite of my position. So the long dollar risk, the market would fall, therefore theoretically would be looking at $3,200 on a really aggressive day. That's what your risk is per contract. If you were to look at conditions right now where the market headed higher and you were short the market, your risk would have been the $2,500. So I'll put together a larger presentation on this, but because there were a number of markets that really worked well in using those charts, and I'll show you where you find these, the original charts I was looking at. You come down to signals and then daily support resistance levels. And then what this will do is it'll bring up all of the primary markets. Here's the S&P 500. If you wanted natural gas, you could, just simply click on it and you'll pull up the natural gas. But here's the S&P 500. So for today, the market closed in about this level on the chart. And tomorrow, this evening for tomorrow, we will use today's close, and then what we'll do is we'll have different numbers and different ideas as to where the market theoretically could head to. So if you were to look at these charts and look at your markets, I would look at the dollar index, the S&P 500, copper, wheat, and lean hogs. All of those markets did very well in forecasting to varying degrees where the market would have headed. The only strange one was with hogs, where it went well above its upper threshold today, but the other ones I just quoted to you did quite well. So just some new content for you to look at. We consider this to be dollar risk, and so again, the way you'd find this for the charts that we're on right now, the support and resistance levels, or you come down to dollar risk. As an example, you come down to the market, and I'll show you a quick shortcut here. Again, I'm going to come back to the S&P 500. You can always just simply come below this chart, click on risk targets, and what that will do is it'll bring you right to these charts where you can then look at not only the S&P 500, but all of the different markets that are actually out there. So keep that in mind. I want you to feel comfortable that they're going to start to add more content to make it easy for people to understand how to use the information, use these targets from the perspective of likely moves to that particular level, and from a dollar risk, could I or can I handle that? Do you have the capital to trade that? And do you have the intestinal fortitude to absorb that kind of a loss? That's the correct way to look at it. we'll do some more of these in the future, and thanks for watching. Bye-bye.